Hi everyone, I'm John Zoller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. Well, it's certainly been a difficult start to the year for investors, with stocks and bonds moving lower in tandem as the Fed and other central banks try to contain the fastest inflation that we've seen in decades. This month, we're trying to tackle the most frequently asked questions that we've received from clients, and so we'll go ahead and get started here with question one. You said in your latest quarterly commentary that the risk of recession is rising over a 2 to 3 year horizon. If that's the case, why aren't we selling and holding more cash? Well, just to clarify, while the near-term risk for markets is inflation, we actually think the longer-term risk is that the Fed has had a pretty checkered past at being able to bring down the level of inflation without causing an economic recession. Now, having said that, the S&P 500 is already down 15% on a year-to-date basis, and the NASDAQ is down around 25%. So we do think that some of this risk is already being discounted in the markets. More importantly, when we design your portfolio, we do so with the expectation that we will have to endure multiple market cycles over your full time horizon. We build portfolios to ride through the ups and downs of the markets because we know that the experience of investors who have tried to time their exit and entry points has historically been undesirable, whereas investors who have stayed the course have benefited from the long-term compounding effect of equities. Keep in mind that over the last 30 years, the S&P 500 has returned around 10% annualized, and that includes a time frame where we've had to endure 4 different recessions. In that sense, even as the outlook is becoming cloudier, it still makes sense to remain patient and invested in the markets. Question 2. My bond portfolio has been down big this year as well. I thought bonds were supposed to protect me during bad years in the stock market. Do bonds still make sense to own now? Well, in normal times, bonds do protect against risk-off environments because investors tend to move into safer assets. The wild card this time around has been inflation, which has been the cause of the sell-off in equities. It's also been the cause of the sell-off in bonds, as interest rates have moved higher to reflect the abrupt change in monetary policy that we've seen. But that doesn't mean that we think bonds don't still have a role in portfolios, and this may be an interesting time for conservative investors to be adding to bonds at more attractive levels. The chart on your screen shows that yields in nearly all major bond categories are now well above their average going back to 2009. From this point forward, we think bonds can still provide capital preservation to a portfolio and now can produce returns that are likely to beat inflation over the long run, something we could not have said over the last few years. Last question. What steps are you taking to respond to the current volatility? Well, as we've already discussed, staying patient and maintaining a long-term perspective is the most critical for investors to weather this storm. But there are a few practical ways for investors to reposition portfolios amidst the current volatility, which would include rebalancing where allocations have moved away from long-term targets, harvesting tax losses and swapping into like securities in order to offset current year gains or even future year gains. And lastly, where appropriate for the client, accessing structured notes where the risk-return trade-off has improved as volatility and interest rates have both increased. As always, we greatly value the opportunity to partner with you in this important aspect of your life and help you navigate periods of volatility like we're experiencing now. As always, we'd encourage you to reach out to your wealth manager at any time to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.